Welcome, is Drew Blazsik here, Logos and Markets. In this video, we're going to do a protective put. This is going to be an option strategy. It's not just about buying a put or a call. What we did before was we just bought the contract. Now this is going to be a little different, a protective put. And again, you can go to Logos and Markets website. You can download the Excel file, which I'll be working on. It'll light up green if you get it correct when we do the function. It's the best way. The goal for me is to teach finance at a broad audience and to teach it in a different way, different method. So Logos and Markets website, or right below this video, you could download the Excel sheet. So let's get to it. What is a protective put? So if you pull up the protective put and you scroll to the right, we can look at the strategy. We want downside protection. We're kind of bullish on this, but that's the strategy. And what is the construction of it? Well, what we did before was just a put contract. We're going to buy a put contract again, and then we're going to buy the stock. So we want to buy the stock and the put, and it should protect us if the stock goes down. So let's look how this works. So what we're going to do is we're going to do what we did before. I want to say the current stock price, what we buy it for, is 100. That's the spot price. The strike price, we're going to say 90 for the put. That means at 90, I have a right to sell. And then we got the put premium. We'll say 3, just like we did before. And then I want this to change of increments of 5%. Again, you could change it to 10%, 1%, 2%, whatever you want to do. It gives you a pretty wide range if you want to see what the graph looks like. The first thing we're going to do, so we're going to long the stock and long the put. And we want to know what is our profit loss on it. We've done the put before, and then we'll do the stock. So let's do that first. So we want to purchase the put, and we want to say, see what is our profit loss. So first thing I want to do is, well, I'm buying the put, so that's going to be we start with the equals. That's going to be a negative premium because that cost me something. Function F4. And then I'm going to say plus, and remember we bought it, so it's a max function. Always put 0. I want whatever is greater. I'm the buyer of the contract, which means I'm going to exercise if I make money. If the contract's going to lose me money, I want 0. That's what we do in max function. And how do we make money in a put? Well, if the stock goes down to 50, it's strike price. I could sell at 90. And the stock is 50, so I make the difference. So it's going to be the strike price. Select the strike price, hit function F4, and that's going to be minus the stock price. I'm going to leave that so it will move as I drag it up and down. And then we can see the put. Again, if we purchase a put and it's out of the money, we're down 3. So I'm going to drag that up. Drag it down. So the most we're going to lose if we're out of the money is $3 because we paid for the contract. Now, if the stock goes below the 90, we can make a profit. And then you want to think about what's the break-even stock price. Well, that's going to be the 87. Well, I'll have it working for you. It didn't work right there. And then, so we got there's our profit loss on the put. And now what I want to know, what is the profit loss on the stock? So I'm going to start that spot price. Actually, we could just go up here, and I could just drag it down. Just do it pretty quick. So you want to think about it. The spot. So we paid 100. That's what this represents. Some people just select the stock price. That doesn't make sense. You don't make that profit. Well, if I buy it for 100 and it goes down to 74, this is the current stock price. So what we're going to do is I'm going to select this current stock price, and I don't want to put dollar signs. I don't want to make that an absolute reference. I want it to drag. So that's it. And then it's going to be minus my costs. Well, the stock minus the cost of purchasing the stock is the 100. I'm going to hit function F4, and that's going to be my profit loss, right? If I bought it for 100 and it goes down to 74, I lost 26. And then I'm going to go drag this down, Control D. And then we can see what the profit loss is on the stock in that example. Okay, so we purchased stock, we purchased the put contract, we got the profit loss. Now what we want to know, what is our protective put strategy profit loss? How much do we make? Because we own both of these and we want to see how much we made. Well, very simple. all it's going to be is the profit in the stock. Because in this example, just to let you know, if you buy a contract, it could be 100 shares of stock. So what we're doing is a 1-for-1 ratio. I'm buying 100 shares of stock with a contract that we have a right to sell 100 shares. So I'm just going to say the stock profit plus the put profit, and that's going to be our protective put profit loss strategy. And I'm going to drag that down. And then that right there is, and what I want to show you before I show you the graph, it caps our losses to $13 because if we purchase the stock at 100, right, that means if I lose 10, it goes down to 90. That means anything below 90, I'm losing $1 in the stock, but I'm making $1 on the put. For every dollar I lose on the stock below 90, I'm making $1 on the put. So really the profit loss is just going to go flat and plus -3 for the contract. That's why it goes down to 90. We lose 10 in the stock and then plus -3. So it caps it out to a -$13 loss. We still make money. But as you see, if I own the stock itself, which is 35, I'm exactly $3 down because that's the cost of the contract. So if we look at the protective put, that's what it looks like. It caps it at -13, so that's where that is, and then it goes up. And if I filter, and if you see what I did here, I just left the protective put. And what I like about these option strategies through the sim method, you could select, let's look at the stock profit. See, that straight line, that's the stock profit. As you can see, if it goes down, we're going to lose a lot of money. It protects us. It's downside protection, right? I'm not going to lose all my money if the stock drops to 0. I'm going to, and this graph doesn't go all the way down to 0. You have to make a lot bigger percentages. But if it goes up, that difference between the protective put and the stock is the premium of the contract for the put. So I just want to show that. If you go to the filter again, you can adjust all that. You can put the profit of that. And what I want to do is I'm just going to take the stock off. That's the put profit loss. Take that off. And one thing I want you to kind of look at, and there's something called a put call parity, that what does this look like? If you purchase the stock and you purchase a put, this kind of looks like a call, doesn't it? That looks like a call. In other words, if you buy the stock and you buy the put, that is equal to holding on to your money, not buying the stock, and buying a call option. They're equally to each other if it's the same underlying asset and if it's the same premium on the put and the call. So that's something some finance majors understand what I'm saying here, but I just want to bring that to your attention. It looks like a call. There you go. There's a protective put strategy. Again, go to Logos and Markets website, and you could download this Excel file, and you could play around with the percentages and see how that works. There you go. Any questions? Please don't hesitate to leave a comment or send.